If you're going to get into commercial real estate, you need to know how to evaluate a commercial real estate investment. That means understanding income, expenses, and everything that goes into it, but ultimately, how do you actually calculate the return when getting into commercial real estate? In this video, I'm going to walk you through how to evaluate a commercial real estate investment, because one of the things that I have learned over the years, nothing has cost investors more money than poorly evaluating deals. So what happens is they look for deals, invest in those deals, and then on the back end of them realize they didn't really underwrite it correctly and found out there's a lot more expense than they thought, there's a lot less income than they thought. But if you learn correctly how to evaluate a deal, this will never happen to you. Now make sure you stick around to the end, because I have a free gift for you today that'll help you expand your understanding of the evaluation process and really how to bust into real estate. Let's get going. I love commercial real estate more than any other type of real estate because of something called forced appreciation. Forced appreciation means that you get to dictate the speed limit of appreciation by increasing the income or decreasing the expenses of a building. Let me explain that real quick. A bank looks at a piece of commercial real estate like a business, meaning the more income it produces, the more value it has. And that's powerful for you, because when you come into a product or a property, you can increase the income or decrease the expenses, and that increases the value of the building. So commercial real estate is really powerful, and understanding how that's evaluated is really important when it comes to forced appreciation, because forced appreciation is often what can turn a deal that looks like a terrible deal into a really good deal. So what I want to do, I'm going to walk through exactly how to evaluate a deal to make sure the next time you're looking at a property, you know if you should go forward or not. So the very first thing you obviously want to look at when you're evaluating a deal is its income. Any deal has often multiple streams of income. If you're in the multifamily game like me, most people look at rent, and that's it. But there are more streams of income than just rent. For example, there's not only rent, but there's institution of pet fees. There's the institution of late fees, application fees, which continue to add income to the balance sheet. You can also add in laundry income. If it's a little bit larger property, there are laundry rooms that the tenants are allowed to use, and that creates more income. You can also create a RUBS system, an RUBS, or a ratio utility billing system. See, in commercial real estate, we have shared utilities that is usually WST, water, sewer, trash. And on those three shared utilities, the tenants can be paying for those. But here's the thing, the owner usually gets the bill. So a lot of times I find properties, the owner's footing 100% of the bill. And one of the ways I increase the value of the building is I shift that, and I take that bill, no matter what it is, and I break it up amongst the tenants so they're covering that bill, so that's not coming out of my pocket. So of course the first thing is you got to know your income. You have to know what income is coming into the building. But it's not just the income, it's where the income can go. Stick around and I'll tell you a little bit more about how you can project future income in just a minute. But if you don't know your income, you don't know your numbers. So when I'm evaluating a deal, one of the first things you need to ask anybody selling a property for is a T12 and a rent roll. What that means is a T12 is a trailing 12. It's simply the last 12 months of financials. What has the property really done over the last 12 months, and how much income has it collected? And the rent roll will tell you what each tenant is actually paying. If it's a retail space and you only have 4 storefronts, then it's pretty easy. You have 4 tenants paying. If it's a 200-unit apartment building, that becomes a little bit more arduous process, and you have to make sure that each tenant is listed on the rent roll. So as you're getting income, the first thing I do is I see what is being paid, but then I see where I can take it. And this often is massive when it comes to deals, because as we talk about forced appreciation, when I can increase that income, I can increase the value of the property. If I have investors putting money into my deals, imagine that. They're putting money into my deals, and I can increase the value, and I just increase the money for those investors, which means they want to invest with me over and over and over again. And that's the power of understanding your income at a more multifaceted rate than just saying, what are the rents? Because that's a very limited scope of the income. The second one is expenses. Now, obviously, you have to know your expenses. This is one of the places I see people underwrite poorly, and it gets them in trouble. One thing that often trips people up in the expense category is taxes, property taxes specifically. And here's why. I look at the taxes that they're paying per year. Let's say I'm buying a 10-unit apartment building. They're paying $10,000 a year in taxes, and therefore, I write that on my evaluation sheet. But here's the problem. Anytime a property changes hands, taxes go up. So when you buy it, your taxes are going to be a little bit more. This trips a lot of people up because they look at what taxes are being paid, they don't increase it, and then they get stuck with a larger bill on the back end, and they're getting less return because they didn't understand how taxes work. So your major expenses are going to be your taxes, insurance, it's going to be your management team, and inside your management team is going to be your vacancy and your loss to lease. A loss to lease is simply anything it costs you to fill a unit when somebody moves out. So that's how much money you lose in order to lease the unit. So you've got your taxes, insurance, management, loss to lease, vacancy, and then you've got your repair budget. So you've got all the maintenance, leaky faucets, leaky toilets, leaky roofs, anything that happens inside the maintenance category. I like to add about 10% in that category for maintenance. But then you've also got contract services, meaning do you hire a landscaper to mow the lawn? Do you hire a CPA to do your taxes? Your admin? Do you have somebody on payroll on site at the property? All these expenses need to be added, or else you're going to come to the end of a project and realize it makes a whole lot less money than you actually thought it did. And then the third thing you need to know is your debt service, meaning how much is it going to cost you to borrow the money. For example, some projects you're going to be able to get in at a 75% LTV or loan to value. What that means is the bank is going to give you 70% of the money and you're only going to have to come up with 25% for a down payment. Where you might get into other projects that are a little more skeptical, it's not making as much money, and the bank might say, we're only going to give 70 or 60% LTV and you need to come up with 30 or 40% of a down payment. Well, that changes the entire game for us. So we need to make sure we understand what kind of debt service we're getting. So the first thing with your debt service, you need to know the LTV the bank is loaning to you, meaning the loan to value. What percentage of the value of the property is the bank willing to loan on this project? The second thing is the interest rate. You need to understand what kind of interest are they charging you. Are they charging you 3.5%, 4.5%, 5.5%? What type of interest are you getting from this loan? And this is often driven by the type of loan you're getting. If you're getting what we call agency debt, you're going to get a much better interest rate, but it's a lot harder to get those loans. A bridge lender will come in and take on that project. The goal is to get that property to health and then transfer it over to a traditional lender. But using a bridge lender, it's going to be more expensive. You'll pay 4% for a traditional lender. A bridge lender might be 6 or 6.5, but your goal is to only use them for 12 to 24 months. So that's what I mean with your debt service. You have to know, number one, you have to know what's my down payment. Then you have to know what's the interest rate. The third thing you need to know is in what term is it amortized? Meaning, how many years is this amortized over? Are we paying this off? If we made every payment, it would be paid off in 25 years, 30 years, 15 years. The length of the loan will determine the amount of down payment. If your down payment's higher, it cuts into your return on investment. So you need to know how long are they amortizing that loan, because the longer they stretch that loan out, the lower your payment's going to be. So the goal is to get a high LTV and a high amortization, because this will get your payment down and you'll be able to receive more return on investment inside the deal. If you want to continue to get more content around evaluating deals, understanding how to find deals, how to find money, make sure you subscribe to our channel and hit the bell notification so you get notified every time we drop one of these videos. So no matter where you're at in the real estate cycle, you can find content to help you get the property to the finish line. Then the fourth thing you need to know as you're evaluating a deal is your cash needed. This is how much money it's going to take you to actually get the deal done. Now, this is driven by a couple things. Number one, it's driven by your down payment. We talked about the debt service, right? It's driven by how much money you need to put down on the loan. If you're putting 25% down versus 35% down, it's a big difference. And so that will dictate your cash needed. But the cash needed is more than just the down payment. You have a couple things in cash needed. Number one, your down payment. But number two, your appraisal. Number three, your inspection. Number four, any capital improvements you need to do the building right away. And also your closing costs. If it's a bigger project, they're also going to make you do first-year insurance and possibly a utility deposit. All of this goes in to your cash needed. This is one of the things that gets investors in trouble. They don't know all the money that's needed to get into the deal. They just look at the deal and say, I need the down payment. There's so many more things that come into play. So make sure as you're looking at cash needed, you list out all the things you actually need to get into the deal. So you want to make sure you evaluate your cash needed. Your cash needed is the number one thing you need to be thinking about before you get into any deal. Of course, you want to make sure the income and expenses are good, so this property is making money, but then you need to know how much cash you need to put into the deal. Because what you're going to find out in a minute is the cash needed is going to dictate your entire return on investment. Because your return on investment is divided by this number. However much money you make in a year gets divided into how much cash you need, and that's your return. So if you don't know how much cash you actually need to get into a deal, or you don't track that, you really don't know your return on investment. It's an important number to know so you know exactly where you stand on the front end of a deal. And let me tell you, when you're talking to investors and you know your exact cash needed and you walk through how you got to those numbers, investors know you know what you're talking about. And then the fifth thing you need to know is, where is the value add? Now, what is value add? Value add is how we're going to increase the income or decrease the expenses. It's how we're going to increase the value of the building. Value adds live in a couple places. Number one, they live in, can we raise rents and increase the income? Can we add in some of those different streams of income that the previous owner has not added in? Can we add in a RUBS system where we're charging the utilities back to the tenants? Can we add in pet fees if it's a multifamily property? Can we add in application fees to increase the value of every applicant and also increase the money we earn at the end of the year? So the question is, you want to ask two questions in value add. Where can the income go up? Where can I add income to this property? Usually that's found in the rent of the tenants or either adding some of these different streams of income. The second way to add value to a property is decreasing expenses. For example, I just acquired a property where we know the taxes are extremely high. We're going to bring in a team and actually fight those taxes, and we'll probably get those taxes cut by 30% because we know they're overtaxing the building. That's one way you can cut expenses. Another way to cut expenses is through a RUBS system. You're paying for the utilities, bill it back to the tenants. While yes, that's a stream of income, it's also a decrease of your expenses because you're not having to pay all that money. Utilities is where I have found the most valuable place to look at decreasing income, because a lot of owners pay for a lot of utilities when they don't have to because they just don't know how to navigate really getting a RUBS system in place so the utilities can be billed to the tenant. And a pro tip for every single commercial real estate investor is to underwrite like a pessimist. And this has saved me so much over the years. Every deal I do, I underwrite like a pessimist. I call it underwriting hard. I make sure the property passes a very hard test in order to get into my portfolio. Because by doing this, it builds confidence with my investors and it makes sure I get into deals that really make me money. Yes, I may have to wait a little longer to do a deal, but you know what? I know when I get into it, it's going to be a really good deal for me and my investors. So when you underwrite like a pessimist. If you think it's going to cost $10,000 a year for utilities, put it up a little higher. Make sure the property makes money even when you've underwritten it pessimistically, because it's going to make sure it protects you against a future thing that happens to the property that might hit your income. Before you leave today, I want to give you a free gift. As you're underwriting deals, you need to understand how to acquire properties, raise capital, and get those deals to the finish line. I've created a free 60-minute training called the Free Multifamily Masterclass. It teaches strategically how to bust into the multifamily market, which is one of the strongest real estate assets in the world. Make sure you click the link below. It's in the description, freemultifamilymasterclass.com, and I'll see you in the training.